Good afternoon, everyone. Welcome to the 7th Galp Open Day. We will now start with the energy transition debate. At the end of the debate, there will be a Q&A session. You can make questions during the debate in the Q&A chat that you can find in the right side of your screen with the question icon mark. Also, to enlarge the streaming window, you can press the slide button. As a moderator of this session, we will have Innes Santos. Innes holds a degree in management by ISCTE and an MBA by Lisbon MBA Nova Católica. She joined Galp in 2002 as an analyst in the corporate finance division. In 2006, she was part of the team that prepared Galp's entry into the capital market, then joining the investor relations team. In 2012, she assumed the management functions of the corporate strategy area within the strategy and investor and relations department, where she will also accumulate responsibility for the functions of market intelligence. The strategy market intelligence area, for which Innes is responsible, has the main challenge to promote a formal and dynamic process of the strategic reflection at Galp, anticipating and analyzing the main trends and critical uncertainties that may impact the energy sector, the company's strategy, and its current and future projects and activities. Please welcome Innes Santos. The floor is yours.
Good afternoon. It's a pleasure to be here today moderating the debate for a topic with such an increasing relevance for the energy sector and in particular for the oil and gas industry. To talk about the main trends of energy transition and how companies are adapting, we have with us today Tom Heggarty. He's a principal analyst in WoodMac Energy Transition Practice, leading global solar PV market research team since 2017, with a particular focus on energy transition and corporate landscape of renewable energy. We have also with us Relancio. He's the head of renewable business at Galp since the end of 2019. He's driving Galp efforts towards diversification of its portfolio. Carlos has more than 15 years experience in the energy sector, all of them in the solar arena across the entire value chain from silicon production to project operations. And last but not least, we have Jorge Fernandes, Head of Innovation at Galp, with more than 20 years experience in innovation management in both B2C and B2B segments across several industries and countries, and from technology transfer, new product development and commercialization to strategic and open innovation management. We will start with a brief presentation for each speaker. We'll then open the debate to touch several trends and critical uncertainties and leave some time at the end for the audience to interact with our speakers and make some questions. Tom, the floor is yours.
Thank you, Innes, and good afternoon, everybody. It's a pleasure to be here. My name's Tom Heggarty. I'm a principal analyst in Wood Mackenzie's energy transition practice, and I lead our coverage of global solar markets here at Wood Mackenzie, as well as covering various aspects of the broader energy transition and the role for the oil and gas sector within that transition. I'm very happy to be taking part in the Open Day today from home in Scotland, and looking forward to a really interesting discussion on what, as Innes says, is a really fascinating topic. So I'll just dive into the first slide. If we can move forward one slide, please. Thank you. So firstly, if we look at how the energy transition will evolve and the need to decarbonize the entire economy, it's really clear that renewable power is going to play an absolutely crucial role. And these are sectors that are poised to see massive growth over the course of the next 30 years. And this slide shows in our 2-degree scenario, so a scenario that meets the ambitions of the Paris Agreement, the increase in power demand that we see from 2019 to 2050, chart on the left-hand side there. And what we can see is enormous growth in power demand across various sectors during that period. And in order to meet that, and if we look at the chart on the right-hand side, we think something in the region of 16 terawatts of new wind, solar and storage to be built over the next 30 years. And in part, this supply is needed to decarbonize the power sector as it is today. But beyond that, we also need to see decarbonization in sectors that are not currently reliant on electricity, like transport, as well as massive growth in new technologies like green hydrogen, so that other sectors of the economy, like steel and petrochemicals, can be decarbonized as well. So bearing in mind that last year the world installed around about 170 gigawatts of wind and solar capacity, building the amount of new low-carbon power supply we need to meet the goals of the Paris Agreement represents a huge challenge. Now, not just in the sense of building the wind turbines, solar modules, battery storage facilities, to meet the targets, but also managing the increased level of volatility in the power supply system that all of this new renewable power will bring, and the subsequent requirements for much more flexible supply on the system as well. And coupled with that, the system will also need to evolve to manage huge levels of distributed electricity supply, which we just haven't seen on the system in the past. So we'll need to see both massive deployment of financial resources in order to deliver the investment that we need to see, but also huge changes in terms of the ways that power markets operate and are regulated to ensure that investors can still make a return. So it's a massive challenge, but also for companies active in the energy sector, this represents a huge opportunity as well. We move on one slide, please. So it's hard to avoid talking about the COVID-19 pandemic and the economic turmoil we all face. And clearly this will have an impact on the level of investment that we see in the renewable power market over the course of the next few years. And on this slide, we show our revised view of global solar PV installations for 2020 and 2021, which you can see have been quite significantly negatively impacted, certainly this year. We've seen project construction delayed by issues in the supply chain and lockdowns causing major logistical headaches for investors as well. And then for earlier stage project development, the fall in power prices is making economics of new projects more challenging, and we see a slightly increased cost of debt as well for investors in renewable power. But we also see governments delaying procurement programs and slowing the interconnection of new projects. So there's a lot of challenges that the industry is facing this year and probably into next year as well. But the good news is that the market generally see these short-term challenges, and we see the fundamentals for the industry are very positive. The challenges clearly posed by climate change haven't gone away, and in fact the pandemic has really increased many people and many organizations' awareness of the urgent need to focus on sustainability in order to tackle the climate crisis. So if we look out beyond 2020, we expect a return to extremely strong growth. This is in solar power, but certainly the same thing could be said for wind and for energy storage as well. And in certain places, the crisis, we think, will accelerate this shift in investment away from fossil fuels and towards renewables, partly as policymakers in various regions, certainly here in the EU, but also in places like Japan, Taiwan, try and focus recovery packages on green investments, build back better. This will all be positive for the long-term health of the renewables sector, but also at very high levels of volatility we've seen in other markets, like the fossil fuel sector, really demonstrate the strong credentials for investment in renewable power as well. So there are lots of reasons to be positive, despite the next couple of years clearly being quite challenging for the industry, as they are for really all industries we see around the world. So I'll just move on to my final slide today. Thank you. So we think the case for investment in renewable power is extremely clear, and markets are still expected to show strong growth over the next 5 years, as we've seen, despite the current challenges. And it's also becoming an extremely diverse and competitive industry as well. And this chart really illustrates the kind of investors that we expect to see deploying capital in the renewable power sector this year. Now, obviously, smaller developers, IPPs, utilities, these companies have played a crucial role in the first phase of growth of renewable power, and they will continue to be absolutely essential in terms of driving this industry forward. But what we've seen is that as the understanding of renewable power technologies has improved, as the level of comfort with risks associated with investing in these technologies has decreased, we started to see more risk-averse investors enter the market as well, particularly funds, pension funds, and the like. And with the huge level of volatility, as I mentioned, that we've seen in other markets, we expect that this will continue more of this risk-averse capital will enter renewable power markets. And then more recently, and reflected in the fact that we're here at Galp's Open Day talking about the energy transition and renewable power, we're starting to see the oil and gas sector play in this industry in a much more active way as well. As you can see on this chart, they account for a relatively small share of investment today, but certainly given the targets seen from many players within the oil and gas space around decarbonising their economies, this is certainly something we'll expect to see continue over the course of the next few years. So that concludes my opening remarks. I'd like to pass over to, I think it's Carlos next, who'll be speaking.
Yeah.
Okay, thank you, Tom. We cannot see what is being broadcasted, but I understand that the presentation is online, yeah? The first slide.
Yes.
Okay.
Now it is.
Okay. Then we can move to the first slide. Okay, perfect. So thank you very much to all attendees that are joining. I would like to briefly describe what is doing Galp in front of the energy transition process. It has been announced, and maybe all of you already know, that there is a very strong commitment that has not been altered by the coronavirus or the COVID, which it amounts to a 40%, at least a 40% of capital allocation from 2020 onwards for all the energy transition activities inside of Galp, and from this, at least 10 to 15% expenditure in renewables. The three pillars where Galp is currently working. It's on the low carbon power generation, where we are committed to develop a sustainable portfolio of renewable power generation, and we have started in Iberia with the acquisition of a portfolio to ACS that I will explain a little bit later. But a part of that we will start ahead with different technologies and different geographies. Also, a second pillar should be the new business models, where we need to understand what, with the electrification process, a lot of new ideas, new businesses are going to appear in the landscape of the business. So we have to identify. We need to be able to identify this, to understand if this is scalable, if it's adding value, and then also to go ahead with them with support and to try to understand these new lines of business. Also, inside of new business model, we could also include the part of mobility services, where we are very active with our company, and of course with the decentralized energy solutions, which are providing to households and companies a solution to save a lot of money and to spread a niche of market that was undervaluated up to now, but it's going to speed up, and every day, every year is going to be more and more important. And the third pillar should be innovation and digitalization, where we are talking about the next generation fuels, low carbon technologies, where our team of innovation is working hard on that, and deliver sustainable and differentiation solutions to the challenges that are appearing right now. So if we move to the next slide, there we can see what is now going directly into the renewable, which we showed before that it was one of these three pillars, which are our targets, and the targets that have been announced and that are not changed with this pandemic that we are saying. It's around 10 gigawatts from now till 2030, with a strong presence in Iberia, but of course exploring other geographies. We have started with this acquisition of a portfolio of 3 gigas, from which 1 giga are under operation and 2 gigas are under development. We will give later a little bit of more detail about that. So it means 100% of this portfolio is solar, but it doesn't mean that the strategy of Galp and renewables is going to be only for solar. The strategy for Galp is going to be diversified. Now we are analyzing, because the market is changing, the technology is evolving a lot, the efficiency of the different technologies are changing, but we are looking also at other technologies such as wind or such as hydro, and also with a very, very accurate focus in storage. We really think that the storage is going to change everything. Storage is going to change the way we understand the market, is going to change the way we understand the technologies, and even the portfolio and the mix that we should go with. It's going to be quite addressed. So how we are working? We have three. Let's say we have divided the structure of the renewables department in Galp according to the life cycle of the project. So because our view is a global view, and we start with we have a department of development where it's origination, development of projects, where we start to see opportunities even from greenfield status. Then we have our own department of engineering and construction. We like to understand and we like to have, and our mentality is owner's mentality, is a proprietary mentality, so we have to take care of the engineering and the construction. And finally, the asset management. So the asset management with, let's say, two components: the technical, the pure operations, technical operations part, and also the energy management to understand, to have an active. So with this, I want to highlight 2 points. The first is that the integrated view of the work is not usual in the market, I can say, because usually these 3 departments in other players in the market are like isolated departments, and that creates problem because development goes in one side, then energy has to design what the development has done, then construction is constrained by prices, then energy management is receiving some impossible topics. Here, all the team is involved since the very beginning, so this is a very important point. And the second important point is that we are not sitting on top of the assets and just receiving incomes and check if the Excel is okay and that we are accomplishing the forecast. Our goal is to be very active managers of our own assets and to be always on the verge of the innovation, not only in the management but also in the way of selling the electricity and trying to improve every day the performance of our plants. So if we go to the next one.
Carlos, 1 minute more, okay?
Okay. Yeah, this is done. So here, this is just the breakdown of what we have about in the transaction. We will become, as soon as we onboard the assets, the largest solar PV operator. And as you can see, the projects are quite well spread around the geography. So if we move to the last slide, this is the view of what we have in Portugal right now. So we are currently in Portugal close to 450 megawatts with 2 main parks, Tima and Enrique, which is currently under development. A very good project in our refinery in Sines, which is a small one, and also with our current small wind park in Valgrande. Thank you.
Jorge? Yeah.
Thank you, Innes. If I could have my slides, good afternoon also from my side. I'll focus on what we're doing at innovation, both in terms of how we are approaching things differently at Galp, but also the type of topics that we are focusing on to accelerate the energy transition and to contribute to decarbonization of the energy markets that we serve. If I could have the next slide, please. So really, our formula that we hope is a winning one is to do things differently and also to do it at a faster pace. We really want to start with the market's view first, looking at different opportunity spaces in circular economy, energy, logistics and digital supply chains, and mobility even beyond energy, and really work our way from the opportunities backwards. For that, of course, we leverage all the technologies at our disposal, but especially have the right attitude and mindset, and have the methodologies that are 21st century, various practice, standard practice by now, design thinking, lean startup, agile, scrum, and so on, as a way to do this. So in a way, what we are aiming for is having the best of both worlds, to have the agility of a scale-up while leveraging the advantages of the parent company to achieve scale fast, in a way the unfair advantage of a company like Galp. Next slide, please. Just to illustrate what we are doing, we are supporting innovation across the entire portfolio of Galp, and we look at it in that regards with the same intent, which is to promote innovation, sustainability, decarbonization across the value chain. And that is not different starting with our upstream business. We do that in a highly collaborative manner, particularly taking advantage of our position in Brazil and our strong investments in R&D and innovation in that regards. And here we just have a few selected examples of the type of things that we have. On one side, we're working on artificial intelligence, big data, in partnership with IBM, where we have a seismic interpretation assisted solution that we are prioritizing now for our own benefit and future support to the market. But we also have other type of hardware solutions like the PipeCom, where we have evolved for the detection of floodings in existing rises. So this is just to illustrate the type of things we do, both in terms of the topics, but also in terms of the collaboration aspect, the open innovation aspect of how we've been doing this for many, many years in the context of our upstream operations. And with that, I ask for the next slide, please. I'm very pleased to reinforce the announcement that my colleague Marco Ferraz did this week. We are once again issuing an open call to the ecosystem to supply us with the project proposals and ideas around the themes of our interest. They are, as you can imagine, very related to our assets and to our operations, both in Brazil but also in the Atlantic. And we're looking at solutions in subsurface, drilling and completion, engineering, production, and of course the topics of digitalization and sustainability that are very transversal. And for that, I would just encourage those with ideas to go to the website and answer to the call, submit your proposal to that email. If we now look at the midstream, next slide please. Here we're looking at decarbonization, our liquid fuels portfolio. Electric mobility is a reality and it's growing very, very fast. Still, there are segments in mobility that are hard to decarbonize that way, and we think that there is ample space for liquid fuels, both in road transportation, but also looking at maritime and aviation that require alternatives with low carbon content. And in that regard, we're looking both at first generation, but especially second generation low carbon fuels, particularly focusing in diesel and jet applications, taking advantage of the favorable feedstock position that we have in Iberia. As you know, to have low carbon fuels, we need to start with other materials other than crude. So here we're looking at forestry and agricultural residues, but also possibly waste, non-recyclable waste that could be fed into the type of technology paths that we are evaluating for the production of low carbon fuels. Here, time to market is absolutely of the essence because there's a window of opportunity and there's a certain benefit in first mover's advantage to have installed capacity to fulfill the quotas, the blending quotas that are being specified at different levels, from national levels to RED II to what is upcoming with the Green Deal. And we think that an integrated business model is very competitive here, so we're working with technology partners and value chain partners to make it happen. Next slide, please. On the commercial side, we're looking at very different solutions. Here it's all about business models, digital solutions, moving our offering beyond fuels, and really servitizing in a kind of Amazon kind of way our offers, particularly to fleet managers and the operators of fleets. For that, we have a strong investment already as Galp in Go With Flow, which is a solution for the management of fleets, particularly electric fleets, and many other solutions. But we think an integrated offer with our Galp fleet card and services could be an integrated one-stop shop package that would really impact the total cost of ownership benefits in terms of cost, time savings, overall experience, but also increased safety and sustainability. So we're working very hard in collaboration with our commercial business unit, but also our Flow colleagues and many partners in the ecosystem that are going to be plug-and-play modules to this one-stop shop that we'll build over time. Next slide.
1 minute more, Jorge. Okay.
Well, thank you, Innes. In parallel, we have just announced that we started a new platform to connect with the ecosystem. We call it Upcoming Energies. It's really our innovation factory to develop new options and to do that fast and at scale. It's similar to what many other brands are using in the market, so it's in that sense a very proven approach, but it's very, very efficient in terms of scouting for scale-ups that we want to leverage in our businesses and operations, but also a very quick way to have client-based pilots that we test the solutions from the market in our own environment, but also that we can develop entire new options in collaboration again with people in the market. And for that, we have identified a series of opportunities. I will not go into those in detail, as you can imagine, but I can just share with you a couple of very practical examples in the next slide that illustrate my point. We're looking at very specific solutions on credit scoring. If I could have the next slide, please. On credit scoring for our new business that helps very quickly to assess the liability risk of a certain new customer, but also we are helping Carlos' team assessing cleaning robot solutions to minimize operating costs in the renewable parks that we have, and we are together with our colleagues in commercial increasingly looking for additional solutions, in this case for last mile logistics. And with that, I would bring it to the end, and I would just hope with the last slide that both of us could illustrate how we are contributing to shaping, the portfolio of a sustainable and profitable integrated energy player embracing energy transition. Thank you very much, and I would be glad to receive any questions.
Thank you all for the presentations, very insightful. Just before we open the debate, let me share some food for thought to heat up the conversation. So we know the energy landscape is changing very quickly, driven by regulation that is forcing the decarbonization of the economy, but also by technology development with increasing implications for the global energy industry and in particular to oil and gas companies. These rapid changes introduce several layers of uncertainty. I think the most important one is the speed of this transition. So while the transformation of the energy system is faster in certain parts of the world, namely in Europe, the speed of the global energy transition remains highly uncertain. And it's also difficult to see what will be the end game of this. So we'll have a winner technology, which one will be, or if there is a winner at all, and what will be the final energy mix. So the outcome of this transition will be very different depending on the regions we are looking into it. And how can we promote a responsible energy transition to a lower carbon economy with reliable, safe, and access to all energy supply when energy needs are expected to increase by more than 20% until 2040, supported by a growing population, and these without jeopardizing the economic development. In this context, companies are facing strategic dilemmas if they will start to diversify into low carbon technologies and business, or just focusing on maximizing their returns from their core and existing business. Also, will COVID-19 and the global economic crisis that we are facing endanger the transition efforts or the green recovery that we are seeing, for instance, with the economic packages that are being announced by the EU will speed up this transition and make new winners at the technological front. So let's try to understand the opinions of our speakers on some of those topics. And Tom, I will start by you. And about the EU efforts to decarbonize, we know they are working towards the net zero carbon emissions by 2050. Do you believe this is realistic? And what will be required to get there?
It's certainly an extremely challenging target. We're a very long way from net zero emissions in Europe today. I mean, the 2020 targets were for 20% emissions reduction, so you're talking a real step change in decarbonisation from where we are today. And even the targets for 2030 are extremely ambitious. If we look at the previously set target being 40%, and we're now talking around 50 to 55% emissions reduction by 2030. So it's not just the long-term ambition that's challenging. The medium-term ambition is extremely difficult as well. But then, clearly, if we believe that we need to meet the challenges set by the Paris Agreement, then Europe needs to lead the way in terms of driving towards net zero. So it's extremely difficult, but it's probably necessary. So what we're going to need to see is just a massive ramp up in investment across a whole host of different technologies. Clearly, the first phase of decarbonisation has come from the phasing out of coal and the growth in wind and solar in the power sector. That's a great start, but it's quite an easy start. I think soon we'll have more or less phased out of coal in Western Europe. Still plenty of coal being burnt in Eastern Europe, but much of the easy work will have been done. We'll need to get to much higher levels of renewable penetration in the power sector, which, as I mentioned in my presentation, leads to challenges around the need for power supply, for new technologies like energy storage, which Carlos mentioned as well. So there's investment across the whole host of different technologies. And then you start to look at things that are pre-commercial, like green hydrogen, to decarbonize sectors that are a bit more difficult to decarbonize, switch to electricity in the steel sector and chemical sector, for example. So in summary, it's extremely, you see a lot of progress across a whole range of different things. And we're a long way from kind of reaching consensus on how we get there, I think.
Okay.
But obviously discussion direction.
Yeah. Thank you, Tom. Jorge, do you believe innovation will help to get to these targets, and how can it help?
Absolutely, Innes. We can only achieve this very ambitious target, as Tom said, with a lot of innovation. In fact, it's just a curiosity that the EIA chief just said that we will need to triple the current spent in innovation by 2030 if we were to achieve this target. So that means that there's a long way to go in terms of the investments, exactly because nobody knows what the end solution will be, and we'll probably need the diversity of technologies to complement one another in order to manage the transition and achieve the end result. So I would second what Tom said, but just adding that innovation can and will contribute a lot, but both the private, but especially the public sector, needs to incentivize this a lot, and I'm encouraged to see that the Green Deal has a lot of subsidies and funds allocated to promote this, with a budget of 750p, so it does seem that Europe is taking the lead also there in funding innovation for decarbonization and managing the energy transition, with topics like storage, renewables, renewable hydrogen as well, all these things being part of the solution that will be required for us to achieve what we want to achieve as a society.
And Jorge, to you also, how do you, in this context, how do you think oil and gas companies should respond or position themselves to the energy transition? And I think a very good question also is, how could be the role of natural gas in this transition?
Well, natural gas at roughly 50% emissions of coal or oil has a particular role in managing that transition, right? In itself can also be a vehicle for further decarbonization once renewable gases can help to partially decarbonize it and eventually replace it towards the 40-50 decades. So I think oil and gas companies can and should take a role in leading this transition, complementing their portfolios with renewables, as we see all the majors doing, and Galp is not exception, and Carlos is here to prove it, taking the lead in that regards. But I do believe that we need to embrace this diversity of technologies with, decarbonizing liquid fuels, further investing in electrification, both of mobility, but in terms of other use cases. But the challenge will be the hard-to-abate sectors that are very much prone to rely on natural gas. And there are solutions that are still not in the money, like hydrogen storage and things like that, could be supported by public-private collaborations and also funding mechanisms to accelerate their penetration into the energy mix. And I think we at Galp are trying to do that, but we need the entire industry to move in that direction to have a compound impact in the emissions.
Thank you, Jorge. And Tom, regarding this part of the natural gas, not only for the hard-to-abate sectors, but also to take care of the intermittency of the renewables, how do you see the role of natural gas in this transition?
Yeah, I mean, clearly natural gas has a role to play there. It's a highly flexible fuel. We see, a lot of peaker plants on the system that can operate in an extremely flexible way to help manage the intermittency that we see, and that's only going to grow. I suppose the key challenge to natural gas in playing that role, I think, is battery storage. Battery storage is a technology that's still somewhat nascent. It's being driven really by the electric vehicle sector. That's around 90% or so of lithium-ion battery market today. So as that sector matures, the cost of lithium-ion batteries for energy storage is going to come down very rapidly, we think. So, our analysis suggests, within the next 10 years or so, in most cases, batteries will be able to provide that flexibility at a lower cost than natural gas. I mean, clearly that depends on the trajectory of carbon prices, of natural gas prices as well, which is highly uncertain, but we think storage is a key competitor to natural gas over the long term. But gas clearly has a role to play over the next 10 years. That can't be denied. It's managing the intermittency that we see today, especially as a lot of conventional capacity coming off of the power system, coal and nuclear. So gas definitely has a role, but longer term, it might be challenging for gas in the power sector.
And that also will depend on the region. So probably in Europe, you'll see that transition being faster, but then in other parts of the world, we're talking about China, India, the transition, the natural gas space will be longer, no? Don't you believe?
Absolutely. There's a lot of regional differences here, and Europe, as you rightly mentioned, is a long way ahead in many respects of the rest of the world, and is somewhat leading in terms of driving the changes we see in technology and policy and business models. So gas, in Asia, is growing extremely rapidly, and not just in the power sector as well, but in non-power sectors, and that's likely to continue. And it can play a really important role in those regions in terms of displacing coal, which is still a really key part of energy in Asia and developing markets. So the gas displacing coal there can play a big role in decarbonisation for sure.
Oh, okay, thank you. Carlos, now for you, who do you see as the big players of global power in renewables, and how do companies like Galp compete with those established players? What are your views on that?
I think the first is to understand how the play is done. Which are the different players that are here, because the diversity of the players is too much, and we need to understand where it's at. When the renewables world started, the type of players again were different depending on in which moment in time of the project, of the life cycle of the project were coming. So in the first part, it was promoters that they were developing the project, they were getting some money, they were making the permissions, and finally they were trying to involve banks to have a project finance because they didn't have money, and then they created this idea of the EPC to bring instead of the warranty of the sponsor, because they didn't have enough warranties, to bring bring the guarantee of the constructor. So, and usually these players sold, once the project was in operation, sold to utilities. The utilities were buying these projects, without risk of development and without risk of construction. Then the utilities were keeping that, or another type of player was the infrastructure funds. Infrastructure funds that would buy only when the project was already in operation, and then usually keep it for 3, 4, 5 years, and then sell it to a pension fund, because the pension fund wanted to avoid the development risk, the construction risk, and even the operations risk during the first years of life. So the role of these players, and at that time, in the beginning, there were no any oil and gas companies in this industry. So the role of each of these players has been moving, and has been expanding. For example, the developer, the promoters that ended at COD, then they start to move and they start to become IPPs, we know some of them in the market that they started with development, and they are ready to accept the development risk till operations, and it's the most full. Utilities start also to take the construction risk, and some of them now even are taking the development risk. And then the pension funds, and the infrastructure funds, the same. So the things are moving. The question now is that when oil and gas companies come or land in the space of the utilities. So I think that I want to compare more with the space where the utilities are. And the market is moving to a way that this market, in the beginning, it was possible to do it with low money because the margins were extremely high. There were some protection, there were feed-in tariffs, etc. So the leverages of the projects were huge. But now it's not that much. The leverages of the project, the percentage of debt that you can raise in a project with the warranties of the project every time come less and less. The prices are not so clear, as they were in previous schemes. So you need to take that risk on you, and the financial institutions are asking you more and more involvement. So now is the time when strong companies like oil and gas companies can have an important role and can play an important role, because we are seeing, and I don't know if Tom can also agree with this forecast, a concentration of companies to be each time bigger, each time more global, and each time more integrated. Because I only spoke about the generation part, but it's also the commercialization part. So, and for this, oil and gas companies are in a very good position. And by the way, Galp, I think that inside the oil and gas companies that are in a very good position, it's an exceptional position due to the size of the company. Because the size of the company is absolutely perfect and appropriate to move quicker than other major companies, but with the power of a strong and steady company with a very strong balance sheet.
Thank you, Carlos. Tom, do you want to add something? Because you mentioned on your presentation that currently the oil and gas companies' share of the investment in renewables is not that relevant, but you believe that in the coming years it will increase. So how do you see this?
Yeah, absolutely. I mean, I can't disagree with anything that Carlos said. The share of the oil and gas companies will certainly grow. I mean, clearly they need to decarbonize given the way that the energy transition is moving, and there's an opportunity here within renewable power. Fully agree. We think the sector is going to consolidate a little bit. That will be one of the key ways that some of the oil and gas players grow, will be through M&A. There are lots of potential assets out there in the market at an early stage of development, or companies that are looking to be acquired effectively. So that will be a way of entering these markets. And agree, I think, as market a little bit riskier potentially, we see more in the way of power purchase agreements and fewer government subsidy programs in place. Then having scale, being able to sell power to companies across different markets, around the clock power purchase agreements. So not just when solar projects or wind projects are produced producing electricity, but selling power, green power, kind of a base load in multiple different countries. That's when having scale, having geographical and technological diversity becomes the real advantage. And the larger players, like oil and gas players or the larger utilities, will be best placed to operate and succeed in those kinds of markets. So yeah, fully agree with Carlos.
Yeah. Okay. Thank you. When we talk about energy transition, we also talk about energy access to modern forms of energy. And we know this is still a huge problem in some parts of the world, even though we have the technology to make it different and to try to get the reach of the energy to more and more people. Carlos, I know this is the theme that you are very acquainted with. What do we need to do to change this paradigm?
Yeah. I would like to say that there was a theory when renewables started, because I read even theories saying that renewables were increasing the energy poverty in the world. So, and the reason, it was quite simple. The reason was that on that time, the renewables were expensive. We are talking that, just for those that are not familiarized, the cost, the capex that you need to install a megawatt of renewable power has fallen in the last, let's say, 10 years in something like 85-90%. So the learning curve of the improvement of the cost has been amazing. So let's say 10 years ago they said, guys, renewables are increasing that. Now the cost race has been won by the renewables. So we can produce the cheaper energy almost worldwide. So this has three effects. Yeah? The first is that the price of the electricity falls down. So when the governments start to implement policies to address the energy poverty, with the same resources, they can solve much more problems. They can really address much more beneficiaries than they could do 5 years ago or 10 years ago. The second is that there is no more subsidies, there are no more feed-in tariffs, there are no more extra costs for the system that has to be supported by taxes and that can be removed the resources. So when it comes to the, let's say, more industrialized world, this is very good because it's cheaper for the governments and it's more feasible for the governments to address this. But when we go to the other parts of the world, also to make the installation of distributed generation is much more cheap than before. And what is more important is that in the non-industrialized or in the, let's say, developing countries, which have a high penetration of fossil, they are paying very expensive OPEX with a very low CAPEX. So they don't invest even, for example, I have been in islands, very poor islands, where the guys that are selling the diesel are giving for free the generators for them to use, and the diesel is extremely expensive. When I say extremely expensive, I mean 10, 15, or 20 times the price that we are paying in Europe. Yeah. So, but now, and this is usually this type of countries need the support every year to pay this OPEX, to pay the operational expenses of these systems that are very expensive to maintain. But if there is a change on this with the renewables, it's possible, and we did that analysis in a country, in a very poor country, which they had a deficit of 250 million euro every year of the system that has to be supported by donors. And we showed them that with an investment of 500 million, so just investing the operational the losses of 2 years, we could build a 100% renewable system with some storage and to give electricity for free. Okay, they should pay only some marginal cost for the distribution cost. So it's the way to change. So it's a really change of paradigm that it can be addressed, and it's possible because of the low cost of the renewables.
Okay. Thank you, Carlos. We are running a little bit short of time, so I will just introduce some questions from the audience. Jorge, this one I will direct to you. and it's regarding the investment that Equinor announced in blue hydrogen, the plant in the UK. And the question is, what is the role of blue hydrogen in the transition to a low-carbon economy, and why not just using natural gas and capture the CO2? Why first converted the natural gas to hydrogen? You want to develop this?
It's not up to me to comment other companies' projects, but the role of low-carbon hydrogen in the transition is very clear bet on the path to renewable hydrogen, the green hydrogen produced out of renewables. It is foreseen that it will be more competitive for the next few years while the scale-up in impact on renewable hydrogen kicks in, and I think that is very much what the EU is fostering, and many companies are looking at that with a lot of interest. I think the interest is to decarbonize gas altogether. Of course, you could put CCS on top, but that is still, an uncertain technology and needs to be validated at that type of scale, like Equinor is doing and others are evaluating as well. So I think at the end there will be a coexistence for a period of time up to a moment where the cost parity of renewable hydrogen will make it the ultimate solution because of the link with renewable energy in the generation part. So I do believe that they will go a little bit hand in hand. Low carbon or blue will go ahead in geographies where you have enough renewable capacity, or let's say existing hydrogen capacity to do so. But I believe the ultimate game is going to be renewable hydrogen once the integration with the renewable power generation will be there at the scale that the EU is fostering. And that's why they're about to announce the strategy for hydrogen on the 8th of July, and they are foreseeing a 17 times growth on low carbon hydrogen, exactly because we are likely to see these type of projects both in low carbon or blue and renewable or green hydrogen going forward in the next decade. Thank you, George.
Now, a question that I would direct to Tom, and I will try to summarize the question. So presently renewables compete with fossil-based systems, and with energy demand increasing and fossil fuels resource horizon shortening, at some points energy prices will increase. And the question is more or less if the investors and companies are aware that the part of the transition to build this low-carbon future and green energy will be financed and developed by the oil and gas sector. Do investors and even companies have that awareness currently, that part of the investment on transition will be done by this sector in particular? Tom?
It's a good question. I suppose if the goal is clear to decarbonize, does it matter where the money comes from? Who's driving that decarbonisation? I'm not sure that's too much of a concern. But clearly there are issues around financing and who finances what and how that evolves, certainly in the measures being taken by the European Commission and various other global institutions to make sure that green investments, or what people are calling green investments, are going in the right direction. So things like the taxonomy that we see being debated in the EU around what does and doesn't constitute a green investment. All of these kinds of things will also be really important to drive the money towards the right place. But I think as long as the goal is the same for everybody, that we drive towards decarbonisation, we need all players in the energy sector to be contributing to that goal. So I'm not sure who's paying for it is necessarily too big.
Okay, thank you. And this is related to Galp. And I will direct it to George. The question is regarding if the efforts on decarbonization of Galp are only related with solar power. George, I think you can answer that, even talking about examples that we have to decarbonize our upstream business and the R&D that we have developed regarding these themes. You want to elaborate on that?
Absolutely. I think it's a transversal theme for all our business units. You mentioned upstream, and we have just been recognized for our efforts with CO2 management and the net mix technology that we're using for that in collaboration with Portuguese and Brazilian universities that has been recognized by ANP in Brazil. and we have IP on that we are now trying to take to the next level, but also in the midstream business, not only in terms of our operations, but in terms of the end products. And I talked about low carbon fuels, first and second generation. Not only that, but also what we are doing in electric mobility. And just a coincidence, now Tesla is the most valuable car company in the world, having surpassed Ford this week. And again, thanks to an outperformance versus the market expectations. So I think we're doing that really across the board. And we need all of these solutions to contribute to a low carbon portfolio down the line. And I think that's very much what we are using as a criteria for the selection of the projects that we focus on. And now with renewables much more in the play, coupling that with storage and so forth, will make it even more resilient for the transition and the future ahead.
Just taking some points to talk about in terms of Tesla and electric mobility, do you believe that Europe is lagging Americans and Chinese in the electric car value chain? Do you think this will evolve going forward?
I think Europe has a strong interest in having an integrated battery value chain within its borders. That's why they have recently created the European Battery Alliance. They have really fostered the investments. We just saw a few months back big subsidies for other players and their investments into gigafactories and some of the integrated value chain supporting them. So I think there is indeed an intent to be as self-sufficient as possible, knowing that these are global chains today, particularly because of the minerals to start from lithium, but also some of the others, cobalt and so forth. So I think we'll see a lot of dynamics in that going forward, and we are, of course, looking at that opportunity as well with great care, because we are at the end of the chain and we have a lot of capabilities that could be applicable there as well.
Okay, thank you, Jorge. This one just for you, because you talked about hydrogen. The audience is asking hydrogen or synthetic fuels.
I think they are part of the same continuum, right? I think hydrogen is a solution that can help to decarbonize hard-to-abate sectors, particularly industries like refineries, but also steel manufacturers, cement, etc. So it can either be a solution used as a feedstock or as an energy source, but it can also become a fuel in the future. Particularly for maritime or aviation, where synthetic fuels can be part of the low-carbon solution of the future. So I think that they're all relevant. They probably have different time horizons until we can see them being utilized at scale.
Okay, thank you. Just to only have 2 minutes more, and to talk about the COVID, Tom, I know that you on your presentation, you said that probably it will have an impact on the short term, probably not on the long term, but do you believe when we couple the COVID and the current low oil price environment, will these affect the plans of the industry to decarbonize, or do you believe they will be stronger after this crisis?
I certainly don't think it changes the long-term ambition. Certainly not negatively. If anything, it strengthens the ambition for many players to decarbonize, because the volatility we've seen in the oil and if you look at the economics of upstream oil and gas projects, $50 or $60 a barrel versus $40 a barrel compared with renewable power projects, the differences in potential returns you might realize are much smaller than they might have been in the past. So there's a clear change in the economics of the relative investment as well, if we see potentially lower oil prices for longer. But we think the move to decarbonize is only going to strengthen, and we've seen that in terms of the announcements around targets from some of the big players in the sector that we've seen. Also announcements around acquisition that have only continued through the crisis. So we don't see this negatively impacting decarbonisation of the sector at all, and if anything, it could accelerate it, we think.
Okay, thank you, Tom. So we are just getting our time out. Thank you, Tom, Carlos, Jorge, for sharing your thoughts on such an important and complex topic that is definitely changing the energy landscape as we know today. And I hope we will be together again to share our views and move forward on this transition. Thank you all.
Thank you. Have a nice
Thank you very
afternoon.
much.
Thank you.
Good afternoon, everyone. Welcome to the transition session. We have 4 rooms running in parallel, all with very interesting presentations, and you are free to move between rooms. At the end of each presentation, there will be a Q&A session. You can make questions during the presentation in the Q&A chat that you can find in the right side of your screen with the question mark. Also, you can enlarge the streaming window using the pressing slides button. As the chair of this session, we will have Yves Sanch. Yves Sanch joined Galp in 2011 for the downstream business in Africa. In 2012, Yves worked at the Gas and Power Procurement Department, and later that year, he has embraced a challenge at the recently created E&P Global Business Development Department. Today, Yves leads the early phase engineering within Global Business Development and is focused on delivering valuable business opportunities to the company. Yves holds a master's degree in mechanical engineer from Institut Superior Technique and a post-graduation in petroleum engineering from the Heriot-Watt University. Please welcome Yves Sanch. The floor is yours.
Thank you, Maria. Good afternoon to you all, and thank you, Maria, for your kind words. It's a pleasure to be here today introducing the Energy Transition session on this last day of the 7th edition of Galp Open Days, this year due to current situation in digital mode. And today I have the pleasure to introduce, as our first speaker of these sessions, Daniel Evans. Daniel is the IHS Market Vice President and leads Markit Global Refining and Marketing Research. Prior to joining IHS, Daniel worked for Statoil in corporate strategy, where he has the responsibility for analyzing business opportunities and framing strategic investments for senior management. Daniel holds a master's degree on civil engineering and construction management from Leeds University and studied jointly at the University of California. Today, Daniel will bring us the topic Beyond 2020, Futures for the Oil Industry. Daniel, the stage is yours.
Thank you very much, Ivo. Let me share my slides. So good afternoon, and thank you very much for having me back at the Galp Open Days. It's a pleasure to be here again, and just wanted to say, first of all, congratulations to you all for hosting this event and for doing it virtually. I know a lot of work goes into it, and I've really enjoyed jumping in and out of sessions over the past few days, so well done to you all. I certainly appreciate that this virtual setup can be a challenge, and maybe a bigger challenge for the audience as it is for the presenters. So I'll try to keep the energy high during this session. So I'm Daniel Evans, and I lead IHS Markit's refining research, and a big part of that is putting together our demand forecasts. And as you can imagine, like many of you, I've had some pretty busy months over the first few months of this year. And today I'm going to talk about some of the work that we've been doing looking at the future of the oil industry, or different futures for the oil industry. And you know, we're obviously living through a period of immense change, and one of the challenges that we're all facing is thinking about how the industry might look 10, 20, 30 years from now, at a time where it's really difficult to say what's going to happen in a month or even a week from now. So the way we've started thinking about it is using a scenario framework, and today I'll share some of the scenarios that we've put together, which give quite a big range of potential outcomes, and we're actually raising some quite big issues here. So, is this just a reset for the industry? Or, on the other hand, could peak oil demand already be behind us in 2019? And on the other hand, might this be the virus that killed the energy transition? And I think that that's probably one of the biggest issues or biggest questions facing the industry today. To what extent is COVID-19 really going to impact the energy transition? And in what way exactly? The energy transition had undoubtedly become the key issue for our industry, And this idea that we're shifting from a world where carbon's free to one where it bears a cost and an increasing cost was well accepted, and companies were adapting their strategies to a world where there was increasing risk on their assets, increasing risk on their businesses. So I think if we sort of rewind 6 months, the direction of travel was pretty clear. Policymakers were driving us towards a lower carbon future, and consumers and investors were important stakeholders in that transition. In places where governments weren't pushing hard enough, companies were taking the lead and driving change. So change was happening, but I would say it was happening slowly, and I think if we're realistic, the path that we were on was not a 2-degree path, so it wasn't aligned with the Paris Climate Agreement. So I think, firstly, there's no doubt that COVID-19 is a disruptive event to the industry, but what I really want to explore in this session is the extent to which it will impact the speed and the direction that the energy transition is moving in. And I think the reason that it's legitimate to ask that question now is that over the past 3 to 6 months, we've seen things that none of us have ever seen before. A global pandemic, confinement measures which kept most of us sitting at home for several months, a shutdown of vast swathes of the economy, a shutdown of transportation systems, and of course an oil shock, the scale and the velocity of which we've never seen before. And in that type of disruptive environment, I think it's possible to consider that this might be an inflection point, not just for the oil industry, but also society. So what might the future look like? Well, I guess there's a lot of bad news on this slide, but the good news is that the worst seems to be over, and we think that April has been the bottom for the market, certainly from an oil demand perspective. But what does that recovery look like? Well, I think on the positive side, we are seeing demand rebound very quickly as the confinement measures are taken away. And that gives us optimism as we move into 2021. But I would say that, and you see this if you look at the grey bars, which are showing total global liquids demand, or the change in total global liquids demand. We don't think that we'll recover all of the demand that we're losing this year in 2021. The shock was asymmetric. It hit different markets at different times. Different products were impacted to different degrees. The recovery is also proving to be asymmetric in the same way. But there are 3 main reasons why we think that it will take time to recoup that lost demand. The first is that the confinement measures that have been put in place are going to be relaxed gradually. And it's going to be a stop-start process, and we're seeing that at the moment where when the virus rises up again, we see the reintroduction of some of these confinement measures which halt the movement of people. The second reason is that we think that some of the changes that have been imposed on us in recent months may be long-lasting even as the confinement measures are removed. And we certainly think that people are going to be cautious in the coming months, particularly with regards to international travel. And the final reason is we're now in the midst of a recession that is greater than any contraction in economic activity since at least the end of the Second World War, potentially the Great Depression. And undoubtedly, that's going to exert some drag on demand going forward. So I think the key message here is that demand is bouncing back. It's bouncing back strongly, but it's going to be some time before we hit 2019 levels. Beyond 2020, 2021, I think there are 2 main factors that will shape the future of oil demand. First is how will it impact consumer behavior, and the second is how will it change political priorities? So firstly, with respect to behavior and the way people's behavior changes, I think the question is, will people go back to working, living, traveling, consuming in the same way that they were previously? Or will there be societal changes that are so significant that they impact the way that we use oil demand? On the policy side, I think what we've seen over the past few months is just how exposed our economies are to highly globalized supply chains. And I think that presents a challenge for policymakers going forward. Do they maintain focus on longer term goals, or do they concentrate on finding quick fixes? Do they remain attached to a highly globalized world, or do they retreat inwards? So when we have laid out our scenarios, those are the things that we're taking into consideration. And we've mapped out these different pathways, but they all have the same starting point, and that's what we're seeing right now. So they all take into account this severe recession and the contraction in global economic activity that we saw in the second quarter was basically the equivalent to totally wiping out the economies of France, Germany, and Portugal. So a massive contraction in economic activity, obviously lower energy prices, but a shift in the way that businesses were operated and people were behaving as well. So that's the starting point. But as we look forward, we start seeing a range of potential outcomes. So these are the three scenarios that we typically use in our work. And COVID-19 has the ability to accentuate different aspects of these scenarios. So rivalry is our base case. It's a scenario where globalization continues, and rivalry in the name really relates to increased competition between different energy carriers. Autonomy in the middle, this is a greener scenario. It's one where technology, changing consumer behavior, and stronger regulation see an acceleration away from fossil fuels in the energy mix. And discord, the scenario that's shown in red on the right, is one where the geopolitical landscape becomes more fragmented, and that creates a long-term period of market weakness. So how do we see COVID-19 impacting these scenarios? Well, in rivalry, we think that the behavioral changes are likely to be limited, but that said, demand is reset at a structurally lower level. In autonomy, we argue that COVID-19 could be the catalyst for significant political and societal change. That would accelerate the energy transition and leave peak oil demand behind us in 2019. And then the final scenario, discord, here we argue that the geopolitical fragmentation could also accelerate. We may see a new wave of populist politicians who basically take globalization, backtrack on the globalization, and take the energy transition and other environmental policies off the table. So from a political and economic perspective, we're painting a picture of three quite different worlds. On the political side, on the left of this slide, to grossly simplify, the same politicians have the choice of pursuing short or long-term agendas and of being inward or outward focused. In rivalry, politicians focus on the nuts and relaunching the economy, so short-term issues, but they remain engaged internationally in institutions like the United Nations that help build consensus on global matters. So the world remains globalized, but politicians do what it takes to kickstart the economy, even if that means adopting policies that prop up dirty industries. And that's exactly what happened after the 2008-2009 financial crisis. And we're starting to see some governments signal that they want to move in that way now as well. In autonomy, in the orange, we believe that politicians would see COVID-19 as an opportunity to drive change. And that means deploying capital selectively, only bailing out companies who commit to going green or going greener, doing things like creating car-free zones, raising taxes on refined products. And I think we're seeing many companies and countries signal that they want to move in this direction. And the Green Recovery Alliance, which is a group of mainly Western European countries and companies, is certainly pushing for a sustainable recovery of this type. And then the final scenario, discord, is really one where politicians focus on short-term fixes, and populist policies see governments back away from the global environmental agenda. They do things like drop fuel economy standards, abandon the subsidies for electric vehicles, and they really move to onshore a lot of industry, even when that's inefficient economically and from an energy consumption perspective. So as a result, shifting to the right-hand side of the slide, the economic recovery could look quite different in these scenarios. In rivalry, you get this strong bounce back because politicians are really doing everything they can to kickstart the economy. Whereas autonomy, the orange line, initially has a slower recovery because some of the dirtier industries are allowed to fail. But over time, we see that the transition to a greener economy actually delivers higher economic growth in the longer run. In discord, the disengagement from international institutions, backtracking from globalization leads to long-term slow growth. So what does all this mean for oil demand? Well, I'll start again with the base case, the rivalry scenario here in blue. In rivalry, demand's reset at a structurally lower level, and you see that on the left-hand side, which compares the rivalry scenario, the blue line with our pre-COVID-19 view on total global liquids demand. For sure, there are some interesting offsetting factors at work here. So people work from home more, but those who do go to work maybe favor their cars a little bit more than public transport. People fly less, but on the other hand, they've got used to having more stuff delivered to their homes. But on balance, we see demand being about 3 million barrels a day lower in this post-COVID-19 world. Now, that might not seem very much in a scenario where we have total global liquids demand in excess of 100 million barrels a day. But if you look at what that does to growth on the right-hand side, we're really talking about eliminating almost a third of the growth that we were expecting in oil demand over the next decade. So what that does is it results in a lower peak demand, and peak demand happening sooner, even in this base case. And clearly that has implications for the need to go and find and develop new oil. So building on that picture and adding the orange autonomy line in here, what we see is that the slower economic growth initially restrains demand, whilst in the longer run, we start seeing the impact of greater efficiency gains, more rapid electrification, and more widespread adoption of lower carbon fuels, which slows demand growth initially from the late 2020s onwards, and eventually drives it down from 2030 onwards. And that decline is particularly sharp in the motor fuel segment, as you can see on the right-hand chart, where there are simply far more low carbon options available to the vehicle fleet going forward. In discord, it's kind of an interesting story of two halves of the decade, and you can see that pretty clearly on the chart on the right-hand side. The first 5 years, we see the slow economic growth really exerting a strong drag on demand. But in the background, some quite interesting things are happening. So you're starting to see the impact of these policy decisions, so slowing efficiency gains, reduced penetration of electric vehicles, reduced penetration of biofuels. And so by the middle of the decade, you start seeing that impact in oil demand. And actually, we end up with quite strong growth in oil demand for the last 5 years of the decade, so above 1 million barrels a day, in spite of the low economic growth. So from a supply perspective, the key issues are really capital discipline and supply management. And in both the rivalry and autonomy scenarios, we believe that there's going to be greater capital discipline, which means that we're unlikely to see a surge in US production similar to what we've seen in previous cycles. And we also believe that in this environment, a lower demand environment, it's going to become more challenging to build a consensus around supply management, and that OPEC will largely abandon a bit ambitions to manage production, and we'll see low-cost producers like Saudi Arabia and Russia deliver most of the base load. In autonomy, I'd say an additional spanner in the works is that this is a scenario where we could see investors back away from major investing in major fossil fuel projects. And as a result, we believe that non-OPEC production could just keep falling in this scenario. In Discord, we argue that there's less capital discipline, and in a lower price environment, this leads to more boom and bust cycles, as you can see shown in the Brent price forecasts on the chart on the right-hand side. So if we think about what this means for greenhouse gas emissions, and this is showing the projections of greenhouse gas emissions by scenario out to 2050. If you just focus on the orange line, what you can see is that this acceleration of decarbonisation in the autonomy scenario significantly reduces greenhouse gas emissions versus where we are today. It actually takes us pretty close to a 2-degree scenario, but it doesn't take us all the way there. So even this scenario that we're painted where peak demand is behind us for oil, is not really compatible with meeting the goals of the Paris Climate Agreement. And as you can see, the emissions in both the rivalry and the Discord scenarios keep rising, and we're looking at something similar to a 3-degree scenario in this case. So I think with that in mind, it's not impossible to imagine that even deeper decarbonisation policies could be in the minds of regulators, and that they could be introduced in more environmentally forward-thinking areas like the EU, like California. So on this slide with a pretty consequential footnote, what I'm showing is 2 additional scenarios that we developed, which take us well below the 2-degree end-of-century temperature rise objective of the Paris Climate Agreement. The building blocks of each scenario are coloured orange here, and what you see is that there are some things that we can't escape from. So we have to have better energy efficiency. We're going to have to lean heavily on nature-based solutions. But from a technology perspective, there are different pathways to get to this sub-2-degree scenario. One of the options is investment in carbon capture and storage. The other direction leans much more heavily on the development of low carbon fuels. And I think that companies at the forefront of the energy transition are going to need to master one or maybe even both of these areas as they look to the future. And the reason for that is that in these scenarios, the downside to oil demand is even more significant than what we were talking about in the autonomy scenario. So by 2030, assuming that some of these policies that encourage the adoption of lower carbon fuels or encourage the development of large-scale CCS, we could see demand more than 20 million barrels a day lower than in our rivalry case by the end of this decade. So which of these scenarios is most likely, or to put it another way and go back to the start, to what extent is COVID-19 really likely to impact the energy transition? Well, I think for sure an event as disruptive as this has the potential to be a major inflection point for the industry. That said, I do think, certainly from a European perspective, it's difficult to imagine politicians really backtracking on the energy transition, and certainly companies are signaling that they want to forge ahead with adopting lower carbon strategies. And I think that we're starting to see some of the signals that certainly Western European politicians are eager to seize on this crisis as an opportunity to accelerate the energy transition. I suppose in the end, the world that we emerge into will be one where it's maybe not as clear-cut as the different scenarios that I've painted here, but combines different elements of each of them in more subtle ways. And I think one of the risks for European countries is that other parts of the world don't view this crisis in the same way, and that if that happens, and if they adopt a scenario pathway that looks more similar to rivalry or discord and puts us on a higher emissions pathway, then European policymakers may push European companies towards some of these deeper decarbonization scenarios. So I'll finish there. Thank you very much again for having me at the Open Days, and I'm happy to take questions, Ivo.
Great presentation, Daniel, as usual. Great presentation. Thank you very much. So I believe that we have here one or two questions at least. The first question is, how do you see that the elections in the United States could influence what you have just mentioned?
I think certainly I would say that pushes us more towards this discord scenario. And there were certainly elements of that before, right? If we think about geopolitical fragmentation, finger pointing, backing away from globalization, protectionism, onshoring of industry, America first, right? That's what it was all about. So I think certainly if President Trump is re-elected, that certainly sets the tone for a scenario that looks more like discord.
Okay, thank you. And I believe that I have a second question. So one of the theories that is often mentioned in the oil and gas industry is the underinvestment that we have faced during the last 5 to 6 years, and that this will lead to a shortage of supply.
Yeah.
And as such, a super cycle in the beginning of the next decade. What do you see, and what's your view on that?
Yeah, I think certainly all the elements are in place for a period of undersupply. Clearly what needs to happen right now is demand needs to rebound. We need to wind down the inventory that has built up over the past 6 months. But I would say that we've seen a very rapid adjustment in production, and some of that we believe will be quite inelastic as demand comes back. So to put it another way, some of the production that's been shut in over the past few months can't be brought back quickly, And certainly the massive contraction that we've seen in US onshore production is unlikely to come back very quickly, right? Because of this increased capital discipline that investors are demanding. So if you combine that picture with one where demand is growing quite strongly, which is a very realistic possibility, we could certainly be setting ourselves up for a period of supply tightness in the say in the middle of this decade.
Okay, thank you, Daniel. I believe that we are running out of time. Thank you for your presentation. Thank you for your time. Good materials that you always bring. And I hope to see you again next year and to be again your chairperson.
Yes, thank you very much for having me. And yeah, I'd love to come back, and hopefully we can do it in person next time.
Exactly. Thank you. So now I have the pleasure to introduce to you our next two guests, Andrew Gibson and Brian Innes. Andrew is the Global Energy and Emissions Practice Lead for Partners and Performance. He has 35 years in executive and management consulting experience in strategy and operations across energy, petroleum mining, metals industries. Andrew holds a PhD in civil engineering from the California Institute of Technology. Brian is an expert for the energy and emissions practice for Partners and Performance. Brian has 20 years of experience in technology, energy management, and renewables. During the last decades, he focused on providing greenhouse gas and energy efficiency advice. Brian holds degrees in material engineering, finance, marketing, and HR. They will bring us the natural gas generation in the energy transition, risks and opportunities. This certainly looks to be a very good presentation. Thank you guys for your presence, and the floor is yours.
Thanks, Ivo. Thanks for the introduction. Yeah, so we've got a few slides here to walk through and hopefully provoke a good discussion, Ivo. In its background, Partners and Performance is a global consulting company that primarily serves resource companies, including mining and oil and gas. So a lot of what we're presenting here has been informed by our experience over the last 5 to 10 years of working with these various companies. And so it's more of an on-the-ground experience, and on-ground is sort of a understanding of where companies are at. I have to say, having listened to this morning's session and hearing some of the efforts that Galp is undertaking, I was truly impressed with how Galp is tackling this transition. It was very informed and thoughtful. As we work with many oil and gas companies, I can tell you a lot of them are in a very different places with respect to how they think about energy and transition. And I think as we talk through this discussion, one thing we've got to continually remind ourselves is that the transition for each region is very, very different. And Europe is certainly well advanced because of the policy and regulatory environment, and that is forcing an early adoption. But we see across the globe a wide spectrum of approach to the energy transition by the different markets. So with that, let me share my screen, and we'll walk through these slides. So, I think we talked earlier today around the economics of electricity generation and supply changing. Carlos from Galp said it very well. He said renewables have won the cost race. And so really what's happening now is market forces are now a key driver of adoption, not just government policy. And that really is changing the frame for businesses and how businesses think about this. And I'm not just talking about oil and gas. I'm also talking about, obviously, other businesses and stakeholders that are interested or are energy consumers. The problem is, and this again was spoken to Tom Heggarty this morning quite well, there are barriers to greater VRE penetration that are emerging. And this is a real issue. In some of the more advanced markets, and certainly we see this in some of the markets in Europe, but we're also seeing it in some of the other advanced markets, Australia, California, the VRE penetration of the variable renewable energy, wind and solar, is effectively getting stalled in its development, not because of the economic investment or attraction, but because of the issue of balancing it within the grid. So the concept of dispatchable generation is becoming incredibly important. Another area that is increasingly getting focus is adapting the transmission. And again, we had some discussion this morning around the challenge of getting access to transmission and developing transmission rights, and these are increasing issues. The last part that I haven't heard much discussion about is this idea of securing reserve power. And this is the so-called when variable renewable energy, solar, wind, is in a low period for a protracted period of time. And I think this is sometimes referred to as the Dunkelflaut, a good German word describing it. But this is increasingly getting attention for regions which are relying more and more on variable renewable energy in their grid. So these are three areas where barriers need to be, or solutions need to be brought to the table to help the advancement of VRE in our grids. So the point of this is that gas infrastructure, and I mean infrastructure in the broader sense of the word, really has an important role to play. And it has an important role to play now to unlock the stalemate we're seeing in some of these markets, and also to help accelerate the adoption of VRE for all the beneficial reasons. Why gas? Look, it's a proven technology. We know it can really be an effective combination with wind and solar, and we'll talk a little bit more about that. The gas infrastructure can certainly solve the Dunkelflaut problem for countries or regions that lack alternatives like hydro or nuclear base or other solutions. It enables a more rapid adoption of VRE. And, to me, this is important because obviously the adoption of VRE has many other benefits that have been discussed at length over the last 3 or 4 days. But this is a quick way to solve much of the barriers that we're seeing around the transmission, the grid issues, and obviously more rapid deployment potentially in emerging markets. The last point here, and there's been good about this today, earlier in the debate session, is that gas infrastructure does have a green future. And I raise this because in some markets globally, we're actually seeing gas come under an emissions cloud, obviously. And that is becoming an issue for adoption of gas as a solution, because in some regions it's being seen as the next coal. And I think this is something that's very counterproductive to the overall advancement of renewable energy and our advancement to emission reduction. So in summary, leveraging our gas infrastructure is really a rational decision, and I think we all need to promote this, especially at this time. I mentioned earlier that gas generation with wind and solar is an effective solution, and this is not just an abstract concept. This is an example that actually Partners in Performance supported, but there are many other examples globally where industrial customers have taken the step to create their own hybrid solutions. And these hybrid solutions can range from anywhere from 10 megawatts up to 100 megawatts in terms of their solution for supplying power demand. These hybrid solutions are effectively self-balancing. So they're usually a combination of gas, if it's available, or a grid backup, if they're connected, but a component of wind and solar. And typically what we're seeing now, the economic point, or the favorable economic point, is around 65% combination of wind and solar, complemented by some sort of reserve power solution. This is an example that Brian was deeply involved with, and if we have time, certainly can field some questions around the specific application. The one thing we wanted to point out here is that repeatedly in our discussions, and we're discussing, have discussions all around the world, we often see a focus on a single solution. So it's talking about wind or it's talking about solar. And I think there is a real missed opportunity here. When you combine the solutions and supplement them with something like gas, it really is a much more favorable, economic, reliable solution to pursue. If we take the self-balancing hybrid plant concept and basically scale it and match it to a demand center, and that demand center could be a sequence of industrial sites, it could be a large urban center, you basically create the energy precinct concept. Again, Carlos mentioned an example earlier today of a country where Galp had done an assessment where a $500 million investment was going to eliminate a $250 million annual deficit that the country was experiencing. Now, this energy precinct probably doesn't apply in mature developed markets with well-developed grids with the strength and resilience, but certainly in emerging markets or developing markets, it does have real application. And I can tell you with discussions with some of our contacts and work in Africa, this is gaining greater interest. And for gas companies that have stranded gas assets sitting in the middle of Africa or close to Africa, this is a great solution to start thinking about how those assets can be reserved and how the company can transform its service for the longer term. So again, happy to discuss a little bit more about some of what we're seeing here in the African context. The part that may seem very obvious, but I haven't heard much discussion about, is leveraging the existing industrial sites to effectively mitigate some of the horizon risk around capital. Obviously, if you use an existing site, it's got a certain infrastructure. So large industrial sites, and by the way, this doesn't have to be an oil and gas site, it could be any large industrial facility, typically have existing infrastructure. They also have disturbed land that's already disturbed. So environmental impacts and incremental environmental impacts are certainly lessened. And the other reason why these leverage of these existing assets, again, Carlos mentioned it this morning, is just the challenge that is being seen today to get access to developed sites in greenfield situations, environmental issues, permitting, access issues. These are all barriers that are limiting the advancement of renewable projects. And again, we're seeing repeatedly in our practice, a lot more industrial companies are turning to renewable solutions, not only for their own demand, but potentially for provisions to the grid or other demand centers using their natural assets of their existing sites. And that's why the case to invest for a company can be incredibly compelling. And when we've looked at these in a variety of countries, jurisdictions, we repeatedly see the economics play out very well. Now, there are some exceptions. If you happen to be sitting in an industrial site sitting in British Columbia with a massive hydro solution and capacity, it's a much more challenging trade-off to invest in alternate renewable energy solutions and hybrid solutions. But why is this compelling? So firstly, it provides a lot of flexibility for the industrial side. One of the things important is it extends its life and improves the asset returns. And we see this over and over again. The hybrid solution that we're talking about typically delivers a lower cost, certainly in the longer term. Once the renewable energy is built, as we all know, the marginal cost of its electricity generation is low. And so therefore that is a huge benefit for the long-term viability of an energy-intensive site. The other thing that we're seeing repeatedly too, that as certainly in developing countries where the grid supply may be less reliable, but even in markets in transition. So we've experienced this in South Australia, the grid actually became unreliable. And for an industrial company that's heavily energy intensive, these disruptions can be incredibly impactful on the operations. Finally, the other thing I'd point out here is all of these companies are under pressure to reduce emissions. Their stakeholders, shareholders, etc. There's a growing awareness that actions need to be taken. And so this, of course, helps them advance towards a firm, concrete emission reduction. The other reason the case can be compelling is just, look, again, they've got existing infrastructure. It's a no-brainer. The marginal capital cost to capture potential additional generating revenue, again, is another option here that makes these cases very lucrative over long term. The final piece here is creating a future option value for the asset. Again, typically these sites have a life. If you're in a mining operation, there's a life of mine. If you're a large industrial operation, there's a certain element of when your asset needs to be rebased or recapitalized. This solution creates a future option value. You're located on owned infrastructure. It's potentially a future green generation when you couple it with VRE plus a gas infrastructure, which we've spoken and heard today, does have a green future, whether it's green fuel substitutes, CCS, or other storage solutions, such as large-scale battery. The last part here is if governments and regulators start to consider what the reserve power need is going to be for a protracted period of low solar or wind periods, the opportunity is that this becomes part of a reserve power solution. Now, today, most developed mature markets have some regulated reserve power opportunity in the event of a major outage. This is certainly going to become more and more prevalent as we move forward and as VRE advance into our grid solutions. So in summary, promoting these solutions, we believe, is really in the public interest and should gain government and policy support. And I think that our evidence in some markets where gas is getting a negative position in this energy transition, I think we've got to advocate very strongly that it can play a very important role over the next 10 years, and certainly jurisdictions like Europe, where we're well advanced, or whether that's 30 years in other regions which are slower off the curve and moving through this. And basically, these are the elements that I think need to be messaged to government and policymakers, and also to the public, around why gas as a transition fuel and a transition solution is in the interest of the public, is in the interest of all of us, to help maintain the pace and implementation of beneficial renewable energy in our grid systems. So with that, I will turn it back over to you, Ivo.
Thank you for your presentation. Very interesting concept that you have there. I believe that we have here one question, and a question that is a little bit provocative, I believe. Let's see. So do you think that the role of gas as an energy transition fuel could be in risk as battery technology and other means to store energy are improved and deployed to effectively storage the energy? And how do you think that it could be for different regions, for example?
Yes, so to be very clear, we ultimately would see that the gas solution is ultimately going to be displaced. So battery storage is one option. Now, it may not be battery storage in the way that people are conceiving it, large battery installations, for example, but we heard earlier today about distributed energy and the impact of electric vehicles. So if we get smart about how to leverage our electric vehicle battery capacity, or it could be rooftop solar solutions, this could obviously be a very effective solution for the grid as a balancing power. There are other ways that this could be also solved. I mean, obviously we've heard about hydrogen earlier today, or other green fuel substitutes. We have a slightly different perspective on how hydrogen may play a role than how it is being conceived in some people's mind as a fuel substitute. We can talk more about that. But absolutely, the ultimate substitution will come when it becomes economic to do so. And as we all know today, large battery solutions are being implemented where the economics can be justified, where they're performing a high-value dispatchable solution, and they're generating high-value peak pricing for that solution. So the example in South Australia is a great example of what was done there. But I still feel that the scale that's required to provide reserve power is well beyond where we're at today. And the scale that's required from a battery storage solution to provide a national reserve power in the event of a 4 or 7 day outage or weak solar wind, the scale required is massive. So I think that's again where alternate solutions like hydrogen start to play a very important role, and why, you know, as we talked earlier, right, The technology and which technology is going to win, I think it was articulated earlier by the moderator, is extremely uncertain right now. So I don't, today sitting here, will there be a substitute for gas? Yes. Which one is it going to be? Who knows? But I think the point is the infrastructure that we have today can be leveraged, and it's a valuable asset to both advance VRE, and it's a valuable asset for companies that they should be thinking harder about how to leverage. So.
Perfect. I wouldn't put it better. I think it was a fantastic answer. I think that we have no more questions, so I will thank you again for your presentation. It was a very good one with a very interesting concept and ideas. So thank you for your time. It was very nice to have you here.
Thank you. Thank you, Ivo. Thank you, Brian.
Thank you all very much. We will return to this room at 4 o'clock with a presentation from Eduard Sala de Vedruna. He will speak about will the COVID-19 crisis accelerate the energy transition in the power sector. I would also like to remember you that we have other sessions going on in room 2 and room 3. We will see you again at 4 o'clock GTM+1 Lisbon time.
So now we have Eduard Sala de Vedruna. Mr. Sala de Vedruna is the Executive Director of Global Power and Renewables at IHS Markit. His team delivered competitive strategy and market analysis to developers, utilities, and renewables equipment manufacturers on key trends and market opportunities. He has more than 17 years of consulting and research experience in energy sector with a focus on market analysis and competitive strategy, particularly with the global renewables market. Today, Mr. Eduard Sala de Vedruna will introduce us to the question: will the COVID-19 crisis accelerate the energy transition in the power sector? A warm welcome to Mr. Sala de Vedruna. Please, the floor is yours.
Yeah, thank you very much, and good afternoon, everyone. So today I want to answer one of the questions that a lot of us have in mind, right? Is this the current COVID-19 crisis? Is it going to accelerate, or on the contrary, is it going to slow down the energy transition in the power sector? In order to answer this question, I decided to structure today's short session in three main blocks. One, the first block, we are going to focus on the impact on power demand that the COVID-19 pandemic is having, and we believe it's going to have during the course of this year. Second block is going to be focusing or providing an overview on how the generation or the different generation technologies have been reacting to this change in demand. And last, the last point is going to be focusing on the future of investments in the power and renewables space. Let me start with a strong statement. It's an unprecedented power demand decline, what the world is facing right now. And COVID is an unprecedented situation with all what it entails. So really, it's a situation that is new for all of us, and it's very hard to predict how things are going to evolve after this pandemic is over. What we are going to focus today more is in the fundamentals that, in our view, are going to shape what the future of the energy transition is going to look like. And first, I think that it's important when we think about the impact, or when we look at the impact of the COVID-19 on the power demand, it's important to notice that the demand has been falling everywhere. It has been falling everywhere since the start or the beginning of the crisis. However, the level of drop that we have observed in the different countries is very different. And this degree is different, related or driven by many different factors. One factor are the weather trends. Was quite noticeable that at the period of the year when the lockdowns were more strict in some countries, like for example in France, demand was almost not suffering. The reason for that was that at the same time we had a very cold week. Another important aspect that explains these differences in terms of drop of demand across different countries is the correlation of power demand to GDP. A third aspect that as well we have observed having or playing an important role has been when and how governments have intervened in the economies and how strict they have been with the lockdowns. Last, another one that is important is the degree of infection itself, right? Different degrees of infection, and this is correlated to the previous one about the level of action or the intensity of the action or the intervention of the governments, right? The degree of infection being different and moving in the form of waves across the globe is having an impact as well on how demand is being impacted across the different markets. Another aspect that is extremely important, and you will see with some examples that I'm going to share with you, is what we call the sectoral composition of the demand. We have countries where demand coming from the industry accounts for the lion's share of the total power demand. On the contrary, we have countries where a commercial commercial related demand, it's the dominant source of demand, and even residential has a significant weight. So with that, I would like to give you some examples of what I just mentioned. Right, is that what you can see here on the left-hand side is what we call the demand composition by market, and you can observe that it's extremely different depending on the countries. Right, in places like China, 70% or nearly 70% of the power demand comes from the industry. So as you can imagine, if there is a lockdown and there is a hard stop of the economy, of the industrial activity, this immediately translates into a drop in demand. On the other hand, you have markets like the New York system operator, more of an operator system, where you see that commercial demand it accounts for more than half of, or nearly half of the total power demand. And this clearly has an impact, because if we focus, for example, in the case of China, and this is the right-hand side of this slide, we see that basically the total power demand in the period of January-February 2020 dropped by nearly 8% in the country. When you look at the industrial demand itself, it dropped by 12%. And this drop was so significant, as you can remember, because if you look at the left-hand side, by the weight of the industrial sector in the total demand. This drop in demand that the industry has experienced in China in the early months of this year were not compensated by a fabulous increase in the demand related to the telecommunications and web services, a demand that increased by 30%. So what we have seen is it's not purely a destruction of demand, as you could imagine. So the COVID-19 has not resulted in a net destruction of demand necessarily, or total net destruction of demand. It has some demand has been shifting from one sector to another. You are all familiar with that, right? When we're not able to go to the office, the commercial consumption declined, but on the contrary, your residential demand increased as a result, as you were doing homework. How this translates into our views, right? I think that what is important is that we have been reviewing downwards the power demand for 2020, and that's true everywhere. Any single market that you can think of, demand has been revised downwards. And just a caveat to this exhibit, this here I'm showing the outlooks as of April 2020, with new cases emerging in different parts of the world, with the situation in the U.S. getting worse, countries like India as well experiencing a high level of cases. This power demand clearly forecasts are going to have to be revised downwards. But what I wanted to show here is more of an illustration of what we have observed, right? So we have seen in places like Italy with a very strict lockdown, we do expect that our demand pre-COVID, that's the green bar, we were expecting a slight increase of demand over the period of 2020. We expect right now nearly 8% decline, or at least an 8% decline in the total demand in 2020. But as well in high growth markets like Vietnam, for example, where we were expecting nearly 9% growth in terms of power demand in 2020 before the COVID-19, we are now expecting a little bit less than 2% power demand increases. So really, if I had to summarize what we observe or what we are showing here, is that it's a global phenomenon really that is impacting all the countries equally, right? The only difference in terms of how negative the demand drop is, it's more related with the starting point in terms of the growth of the power systems that we were expecting, rather than the absolute impact. So this is one side of the coin, right? Is that how demand has been impacted by COVID-19. But on the other side, let's look at how supply has reacted to this drop of demand. So what we are seeing, and this is an important aspect maybe to remind for some of you who are not familiar with the power systems, But in many countries around the world, wind and solar are starting to become an increasing or to have an increasing weight in the total generation. And as you might know, renewables they have a nearly zero marginal cost of generation. So that means that when you have a renewable asset that is up and running, the cost of having it producing is nearly zero. As a result, that means that when the demand has gone down, so the total demand has a squeeze, the amount of supply has remained the same, but the relative weight of renewables in the total generation has increased. This had, of course, this is having impact on the other sources of generation, fuel-based generation sources, like, for example, gas and coal, that had to compete for the leftovers in terms of demand, right? What we call the residual load, the amount of load that once the renewables have already generated the electricity, the amount of load that needs to be supplied. So this is squeeze in the amount of residual load has resulted in prices collapsing in the liberalized markets, and clearly that is having an impact on the profitability of the assets. So renewables going up, clearly solar going up in all the countries that we have been looking at. And then we have for the two main thermal generation sources, coal and gas, two different stories that in fact are interrelated. On one hand, we have coal taking the biggest hit with drops in the range of 9% to 40%. That is quite significant. But at the same time, what we are having is that gas that you would expect that would suffer as well has been performing relatively well across different markets. The reasons for that are different. One reason is related to policy. So we have seen policies banning the generation from coal, and these are more pollution-related measures. We have seen that in Korea. We have seen that in Japan, having an impact on gas replacing coal as a source of generation. We have seen as well. We have observed as well more economically driven changes or switches, right, in terms of generation. We have seen, for example, in the case of India, extremely low gas prices driven by the drop of demand and abundance of LNG in the region has resulted in extremely low gas prices, and the fact as well that industries were not consuming this gas, so the total gas available increased significantly for a demand that was limited. That resulted in very low prices, and a lot of generators, they have considered switching their coal-fired generation and to start burning gas instead. That explains some of the, I would say, divergent evolutions of generation between coal and gas. Once that we have gone through the present, right? It's the present and the immediate future. What is happening or what had happened to demand and what we think is going to happen to demand, how generation has been reacting to this demand. Clearly, the question that I was asking at the beginning of the session and I'm trying to answer is that, okay, so what that means for the energy transition. We know that governments are under a lot of pressure. We know that unemployment rates are growing. We know that the economic crisis is becoming a global economic crisis, quite deep, unprecedented situation, as I mentioned. So will countries continue to support the build-out of renewables? Will we continue to see a massive build-out of renewables across the globe? And I think that in order to answer this question, we should think about that issue, I would say, in two ways, right? Or in two steps. One would be the short term, and the other one would be the long term. It's true that in the short term, renewables are under a lot of pressure, but not just renewables, let's be honest. I think that the entire economy is under pressure. We have things like we have demand destruction, so there is less need for new capacity to be added. We have as well exchange rate volatility across the globe. This is preventing from renewables being a global investment. This is, of course, creating a little bit of risk awareness, no, from investors that prefer to have a sort of wait and see approach to the financing of renewables. But again, as I said, I think that this is an aspect that is not just impacting renewables. Then we have something that is important, and you have maybe observed in some of your home markets. It's a policy shift away from renewables. But more than a complete shift is more a standby, right? Countries putting on hold some tenders, governments delaying some of the announcements that they were making, having a sort of a wait-and-see attitude that is more driven by the need of answering short-term needs or giving solutions to short-term needs to the population, rather than really a fundamental change in the approach that the governments have to the build-out of renewables. Another aspect that is not negligible, but that this is more of a physical limitation, and again, this is not exclusive to renewables, are the supply chain disruptions. The only issue with supply chain disruptions is that renewables, they rely, and notably when you think about solar PV, it relies heavily on the supply chain from China. So when China went under a strict lockdown, there was a scarcity of equipment, so that delayed some of the installations that are resuming as we speak, right? Other supply chain related disruptions are more related to the execution of the project itself, right? It's transporting the equipment, the EPC work, right? Lack of staff in order to do the installation. This is a sort of physical disruption that, as the lockdowns are being removed in many parts of the world, we are seeing that taking over again. Another aspect that is important, and this is going to have more of an impact in the long term, is that as we have low power prices, especially in liberalized markets, as I said, demand going down, residual load getting squeezed, prices go down. And this is important because a lot of the renewables that were going to be built, especially across Europe and in other mature markets, were going to be built on a merchant basis, right? Or trying to compete on a semi-merchant basis with other sources of generation. So clearly, the power price level, it's an indicator of the level of revenue that renewables can get. With power prices going down, clearly there is less of an incentive for renewables in order to be built. But again, this is true for renewables as it is true for other sources of new generation. And then, last but not least, and related to this moment of uncertainty, right? It's all this capital being a little bit more reluctant to commit into very long-term investments, right? So it's more of a risk-adverse approach from investors that they want to have more clear messages from the policymakers, especially that the long-term picture for renewables remains bright. And that brings us to the long-term drivers, that I think that this is basically what we should be focusing on, because the short-term issues around renewables, we can focus on renewables, but almost everything that I mentioned here on renewables is exactly true for other sectors of the economy. But let's think about the long-term drivers. The long-term drivers, one of the things that renewables or that the crisis helped some decision makers to realize was about some of the key attributes that renewables have. So one aspect that is important is that demand growth is going to continue. If we look at the amount of people that don't have access to electricity, we do look at the amount of new people that will come to the world that will need access to electricity. And if we look at how emerging economies will be growing in the long term, clearly this translates in the need for a significant amount of capacity to be built. And the question is, which technologies are going to be providing this new generation? Well, renewables have an advantage. They have the advantage of improving technology economics. This is an important driver. Was not true maybe 2 years ago. Now it's true. Renewables in many parts of the world are the cheapest source of new generation. And even in some parts of the world, there even a new renewable asset is cheaper than running an existing thermal asset. So that's an important aspect, the improving technology economics that, in our view, are going to continue over time. Two aspects that I think that this time of crisis have put more in value is the fact that renewables help to energy independence. More or less, everywhere in the world, every single country in the world has access to a renewable source. Can be wind, can be solar, can be biomass, can be geothermal, can be whatever it is. But especially wind and solar. You have wind and solar, or wind and solar, almost everywhere in the world. And this is clearly something that governments are looking at with different eyes, right? It's an aspect that is going to be extremely valuable and valued by decision makers. And related to that is that renewables enable your economy to get protected from fuel price movements, right? We have seen fuel price movements. Right now we are in prices that are going down, but prices are expected to go up again, for example, for gas in the US next year. So this fluctuation of cost and this lack of predictability, it's something that renewables don't have. An overarching theme that is not disappearing, right? We are dealing with the pandemic of COVID-19, but COVID-19 is not going to end with the human being, right? Climate change might. And climate change is still there. It's really the topic that needs to be addressed, and clearly renewables will play a key role in addressing or helping in this climate change fight. And then, last but not least, the job creation aspect, right? When you look at some of the reports the International Labour Organization, for example, has issued around the number of jobs that different power generation technologies produce per each million invested, you have renewables, especially solar PV, being the one that has the highest ratio. So clearly, in a moment where governments are trying to redynamize their economies, they are trying to inject money in order to recover the level of economic activity and, of course, to create or to recover some of the jobs that this pandemic has destroyed, or this crisis related to the pandemic has destroyed. Clearly, investing in a sort of Green Deal seems to be a sensible option. And I think that when we think about the cost competitiveness, I think that these two exhibits, I think that are quite illustrative of what I was trying to convey as a message, right? These exhibits, we are showing the levelized cost of electricity, so the cost of producing 1 megawatt hour of electricity from different sources of generation. Here we show onshore wind, offshore wind, and utility scale PV, and then the ranges that we have here, the light blue and the gray bars that we see here horizontally represent what is the marginal cost of generating via gas-fired generation or coal-fired generation. And the bars, the horizontal bars, represent the marginal cost. So it really is the variable cost of producing through these fuels for existing assets, and the dots represent the cost for a new build asset. And then on the right, the same picture in 2050. So I think that this is what we call the slide of the 3 C's, or that's the name I gave it. I think that it can be summarized in 3 words that all of the 3 start with a C. One is convergence. It's a convergence between countries. We are seeing that the spread in terms of cost of the technologies across countries is getting narrow. That's an important aspect, and that speaks about the globalization of the renewables build out and of the supply chains. Second word is convergence again, is convergence between technologies. So right now, the difference between the spread between different type of technologies is relatively big. We have offshore wind being by far the most expensive technology, and wind and solar with very big ranges in terms of cost. We are going to see a convergence as well of these technologies that in the long term are going to be competing more or less with the same level of cost of electricity. And the third aspect, the third word is competition. The third C is competition between renewables and the other sources of generation. So renewables really challenging existing operational assets, thermal assets. And when you look at this picture, that clearly is not a nice picture for investors, right? When they think about an asset that in 20 years' time, 30 years' time is going to be challenged by new installations coming from renewables, clearly that makes investors think it twice before committing in long-term investment in thermal generation. So with all that and with all these drivers in mind, we still believe that at least 80% of the new power generation is going to come from renewables globally. Of course, as you see here, we are going to still see some coal being built, but that's more the result of the short-term situation that I was referring to when I was looking at the short-term drivers of the slowdown of renewables. We still see in India some build-out on the pipeline of coal that is going to be important, but in the long run, we believe that over 80% of all the capacity is going to come from renewable sources, and in places like China, Europe, and the US, nearly 100% of all the new additions is going to come from renewable sources. And with that, I would like to leave with you some of the key takeaways of what I presented today. A short session, I know, many important topics to cover in a short time. But basically, what we are having, the four messages is that demand is going down, and demand has been going down. We have seen ranges of drops between the 5 and 20%, so really very dispersed. And the reason behind that is that the different structures of the demand in the different markets, the nature of what we call the nature of the economic vulnerabilities, the way how the countries have responded, and the structure itself of the power markets really had something to play, an important role to play in these divergences. Second aspect that is important is that renewables, in terms of generation, the renewables have performed pretty well in almost all the countries. It's more noticeable for solar photovoltaic than, for example, for onshore wind, and that coal has been the technology that has been the hardest hit, that got the hardest hit globally. And I think that this is going to accelerate its decommissioning, especially in the markets where decommissioning of coal was already taking place. We do expect as a result that renewables investments in the short term are going to slow down to what we had in our previous outlooks pre-COVID. However, when we think about the long term, our outlooks are more optimistic and more ambitious when it comes to renewables than they used to be. So short term, bump in the road. Long term, stronger fundamentals that result in a higher level of additions. And as I said in my very last slide, we expect that over 80% of all the new capacity that is going to be built. We are currently reviewing our forecast for the long term. We're going to issue them in a couple of weeks' time. We expect that at least 80% of all the new power capacity will be coming from renewable generation sources. And with that, I would leave it here. I would pause and wait for questions, if any. Thank you very much.
Very good. Thank you very much for your presentation. I think that you have gathered a lot of interest from the audience, and I think that I have here quite a few questions for you. So, which is also a very good point to start. So one of the questions, the first one, is if COVID-19 can push governments to be more protectionist, and how may that affect renewable energy landscape? Could Europe create its own renewable energy supply chain? That's the first question that is actually composed of three questions.
Okay. I think that the answer is yes, more protectionism for sure. For sure. I think that protectionism for two reasons. One is because players have realized, or countries have realized, that their dependence to China was extremely high, too high. So this is going to change the mindset. We have seen that already from not just governments. We have seen as well companies, right, rethinking the way how they are sourcing equipment globally. We have seen that in the renewables space, but we are seeing that in the automotive space as well, right? Companies rethinking their dependence on the Chinese market. So clearly, that's an aspect that can you call protectionism? I think it's more about awareness, right? And I would say it's more about risk balancing in terms of sourcing. Then, of course, there is the protectionist element of it, right? Is that manufacturers, and this is relates to my point about job creation. Governments believe that renewables can be the next revolution, right, or deal. No, it's like the New Deal, right? We call it the Green Deal in Europe. It's really you can create jobs, you can create wealth by investing in renewables. It's something that you had already to do, but then it's a very good excuse in the current situation because it's going to enable governments to create jobs. So clearly this is going to happen. The question is that, and that's your point. The last question was: is there the possibility for Europe to create a supply chain? Well, I think that it depends. When you think about solar, for example, right? If you think about solar, the machinery to produce the panels is designed in Germany. The panels themselves are manufactured in China, but the installation is done in Europe by European people. So when you expect that basically the cost declines that we are seeing for solar PV, for example, are going to come more from the panel side, then that means that we are going to have the weight of what is not produced locally is going to decrease over time. So I think that the governments might not be tempted. Well, some governments might, yes, but I think that it might not make a lot of sense for Europe just to insource back the manufacturing of solar panels, for example. That's something that I don't think that we are going to see. However, all the other aspects around, I think that they are going to be much more localized. And then the case of the U.S. is a slightly different story where you have this element of pride around, and there is a sort of commercial war between China and the U.S. We have seen already some protectionist measures going on, but at the same time, as I said, right, a significant part of the added value and the wealth creation around developing solar, for example, it's more related to what is not the panel itself. It's more around the balance of plant, the installation, the maintenance, and these are type of things that have to be done locally anyway.
Okay, perfect. Unfortunately, we are already on time for the next session, and despite the questions that I have here, I cannot
Happy to follow.
To do it, but yeah,
happy to follow up with the questions if you want. Just share them with me, and I will do the follow-up.
We will do it certainly. Perfect. Thank you very much for your presence here and for your presentation. I think it was very insightful, and as I said before, it was one that gathered a lot of attention from the public and the audience. Thank you very much for your presentation.
Thank you very much.
De nada.
Thank you very much.
So, our next guest and final guest for this session is Alexandre Lobo. I have the pleasure to introduce him. Alexandre Lobo is the sales manager for the solar market at Siemens since 2019. Alexandre is also a member of 2 DGAG National Technical Commissions as Siemens representative. Previously, Alexandre worked in Siemens Low and Medium Voltage Business Development Group for industry and infrastructure segments. Alexandre holds a degree on energy and power systems from ISEL and a post-graduation on energy systems focused on renewables. Today, Alexandre will bring us the topic large-scale solar plants, design decisions versus energy yield. Alexandre, thank you very much for your presence. The floor is yours.
Thank you, Ivo, for the nice presentation. I'm very obliged to be invited for this presentation, and I hope to share with the listeners some of the insights that we have been studying according to these new topics of solar power plants. So I would like to start by, I think that my screen isn't being shared yet. Now it is. Can you confirm me, Ivo, please?
Yes, it is.
Okay, so thank you very much. So Large-scale solar power plants. Today, PV plants are at least the most democratic energy source available. Anybody from a single person to a large corporation can produce electrical energy from solar. Okay, and this has an added value also of being very accessible, the sun, and also of having very low CO2 emissions. Well, the only catch on this energy is that it is only available when the sun is available at the right intensity and with the correct direction. So, for the PV solar, there are some metrics that we are bombarded on a daily basis. Words like LCOE and many other words, performance ratios, and so on. And when we are designing or exploring a solar PV plant, we must somehow take the right decisions in order to make the best return of our investment. The economics, as I said, are mainly driven by one indicator that are the levelized cost of energy. This as a representation of how much money I have invested to produce a certain amount of electrical energy. One important aspect for this is the initial investment. On a PV plant, this initial investment can represent something in the scale of 90 or even 95% of the total investment of the costs, this excluding the financing costs, being the remainder of the costs, mainly studies, licensing and terrain fees for the operation of the plant. Well, one particular characteristic of a PV plant is that once it is operating, to produce one extra megawatt is either of no extra cost or not possible at all. So to have a power plant is to design it and to operate it at its maximum capacity possible for the PV plant. Only to have an insight, a PV plant nowadays has an expected lifespan of more than 20 years, being that some critical components have a lifespan of 25 years, more or less 25 years. So we are looking mainly at a capex business. Capital cost plays an important role, and for this reason, what we design at the beginning will take a major impact in the lifespan of our investment. Only to have to share with you some of the concepts that I have referred to, the PV metrics of LCOE, how it is calculated. And one key issue that I would like to point out is that nowadays one can expect, and it is possible to reach, a cost of electricity of 13 euro per megawatt on a PV plant. This said differently, if we are looking at the electricity that we buy at home, this would be 1.3 cents of an euro per kilowatt, being that you can imagine in Portugal, only to have an idea, we are paying something around 15 to 20 cents per kilowatt of electrical energy. So 1.3 is at the moment one of the lowest values ever achieved for any energy source in terms of producing electricity. And for this reason, PV plants will be a must-have in our energy mix for electricity production. So the PV design of a power plant have some constraints. On the right side of your screen, we have a aerial view of a typical large-scale solar plant. One key issue for the investor or for the operator of this PV plant is to have the right return on investment or the internal revenue rate. But to achieve this, there are several external factors that contribute to a best yield or a best rate. One being the available area. Not every area is somehow the right area. The orography of the terrain and some difficulties that one can find on the terrain, like rocks and other barriers, can decrease the terrain occupation. Another important factor will be the radiation, some climatic conditions, and also the environmental impact. Sometimes we have restrictions on the surface that we can use and the impact on the terrain that we are having for constructing such a plant. Also, one key important factor is that we produce the energy on the plant, but we have to put it on our grid, electrical grid, and how far is this electrical grid, and how much does it cost to get the energy from the plant to the grid. Concerning the different grids that one country has, also some technical conditions must be met. All these factors will have an impact on designing the system. Here I'm sharing with you a typical example of a plant which can be composed of several small parts of solar panels, with a first stage of collecting energy inside the PV plant. Then we have a main step-up substation to connect the grid. And from this point on, we are looking at the already existing grid at a national scale. So, an utility PV plant nowadays have several capex costs that we can look at, being one of the typical number for Portugal. This depends a lot on the countries that we are looking at. For Portugal, we can have values ranging from 400,000 euro per megawatt up to 500,000 euros per megawatt. And this is excluding capital costs, terrain leases, being the main drivers for these costs. Panels. Panels amount up to 50% of the total investment. Then we have the inverters. We have also the cost of the electrical installation. Electrical cables is excluded on this value, and the mechanical installation in order to fix the panels to the ground. Could be a fixed installation or a tracker installation, but these are the main four drivers of the costs for our initial investment on the plant. So, on the coming years, we are somehow expecting that this capex value to reduce, mainly thanks to reductions on the panels costs. The industry on panels are still evolving and reducing the cost of manufacturing, but the remainder of the components, they are already available in the global market for several years, and they have a high maturity of optimization, and this makes that the price variation on these products will be mainly varying according to the commodities and other market variations. So on this side, one can expect some reduction of the investment, but not a sizable one. I can tell you that this value nowadays is 1/10 of the value 10 years ago. Okay. One hot topic for the developers is the people availability for the on-site works. Nowadays, there are many PV plants being erected around the world, in Portugal also, and there aren't that many people available to make the construction of the plant. So, being the main driver of the cost, the panels, everybody is looking at the panels, their technologies. We have monofacial technologies, bifacial panels. This means that the panel can get the sunlight from above and from below, reflected by the earth, okay? And we can have the fixed installation or a tracked installation to follow the sun from east to west. Also, another key component are the inverters. We have several technologies, multi-string inverters, string inverters, central inverters. We will come to more into detail up front. And these have some influence also on the plant energy production. Inverters installation. One can put inverters near to the panels or close to the power concentration step-up power station. Another key issue is how much power I'm going to concentrate to later on transport to our national grid. So, the panels, as I said earlier, are a key issue. Typically, for Portugal, we are facing a strong prevalence of monofacial panels. When choosing the right panel, one must look first the specific power for like watt by square meter. Also, one important indicator is the panel deterioration during its life cycle. If a panel produces in the first year 100%, it's expected that he is only able to produce, let's say, 98%, and also their quality. So when choosing these panels, one should take into consideration first the manufacturer references around the world, and secondly, their financials, because we are buying something with warranties for 15 plus years, and one needs the manufacturer to be present if some difficulty arises during the plant exploration. Panels are being developed, and it is very typical for the design phase to have one panel, and during the construction, this model is no longer available. So this evaluation must be done several times during the study of the PV plant. One key point is that, unfortunately, it is not possible to mix different types or models of panels in one PV plant. One single panel can have a strong effect on the energy that the plant can output. One single one in the middle of, let's say, 100 can have an effect of more than 5% if it isn't on the right characteristics, considering the other 99 panels. So we have an array of panels, and all must be of the same model, preferably the same model. So for this reason, when we are looking at the panels, one should have panel acceptance tests being at delivery and also at after the installation, and also some extra panels must be already procured and stored for problems like damage from breaking some panels due to some external conditions, or even some damage that can occur from the quality of the panels. Some defects can occur during the plant exploration. So, as I said, one must look at the efficiency of the panel. The higher the efficiency, the better its production. So we have typically nowadays 18.5%, but I have seen several plants already installing panels of 20%. The costs are more or less below 200. Oops, sorry. The costs are more or less below 200 euro per watt peak, and the degradation of a panel nowadays should be better than the values that I'm showing here, about 2% on the first year and 0.55% on the years following that first year. So I was, during this last minute, explaining some of the characteristics of bifacial panels, monofacial panels, sorry. Bifacial panels have a strong implementation on terrains that have some adequate albedo, like rooftops or light color surfaces. So they are mainly used for different locations other than Portugal, in which the albedo is usually low. But some specific locations can accommodate bifacial panels. Mainly the northern latitudes are more prone to accommodate this kind of panels.
Also, you have 5 minutes to then allow some time for the Q&A as well, okay?
Okay, correct. I will speed up. So I will speed up. These are key issues that will be available for later consultation, and I would come into inverter technology. Okay. So on inverter technology, as I said previously, we have three main inverter technologies: the multi-MPPT string inverters, the single MPPT inverters, and the central inverters. One key issue is that nowadays the panels are installed with much more power than the needed in order for the sun to have a possibility to develop more power, only limited by the connection to the grid. This is one type of oversizing for fixed panels, and another way to do it is with trackers. So, since MPPTs only work when the inverter is not at maximum power, and large solar scale are using always oversizing of the panels, multi-MPPT is most of the times an unneeded flexibility. Also decreases the reliability during the life cycle of the inverter. So, coming back to the inverter installation, this is one set of panels, an inverter, and a step-up power station. Here we can put the inverter near the panel or near the power station. We have some cables to connect it, and whenever the terrain is rugged and the panels aren't exactly aligned, one should use multi-MPPT inverters. Whenever the terrain is an even terrain, one should use a single MPPT inverter and probably and most likely close to the power station. Sorry. In the end, we have also big central inverters that do a two-in-one inverters and power station in one single product. The idea here is to use these central inverters for power plants higher than 25 megawatts. From 10 megawatts, one can start using that solution, but the best yield is achieved whenever we are looking at higher than 25 megawatts. One important topic that I would like to point out, and I will pass through, the presentation is available for further study, is that by doing this configuration, we will reach much higher power output in the range of something like 98% of the available power output. And when we have the inverters near to the panels, we will have it much lower efficiency of our installation. Here are some metrics, Here are some metrics. We are talking about 3.3 extra energy. And the funny thing about these configurations is that also the costs are decreased. On the inverter near to the power station, we will decrease the 1.3 total capex regarding an inverter near the panel. So, combining the two effects, we will have 3% extra energy yield against a decrease on investment of 1.3% of the total investment. I would like to share with you also the power stations, the step-up power stations. The idea is to save costs in transportation, and mainly we have three kinds of step-up power stations. This is a central inverter with step-up power station included. Here we have a more conventional power station, a concrete one, that could also be in metallic containers. And last but not least, I have seen also for smaller scale utilities a concept design of a cork composite for 1 megawatt power stations. Usually, these power stations should be addressed for a design for the Portuguese case around 5 megawatts. For the southern part of Portugal, could be up to 6-7 megawatts, and for the northern part of Portugal, should be around 4-3 megawatts, being the middle ground, the 5 megawatts. Ivo, I think this would be the time for to allow some questions. I have to move a little bit faster in some topics.
No problem. Thank you very much for your presentation. So we have here many questions. I don't think that we will be able to do all of them, but we will forward them to you afterwards, the ones that we cannot answer here today. So I will start with the first one. How much do you see the efficiency of the panels improving, and what is the theoretical limit for the panels efficiency? You mentioned 20%, 18% currently?
Yeah, 18.5 was the number that is being commonly used, but I have seen already numbers of 20+%. And with the current technology available, there are still many other technologies being studied. I expect that one can get to 25%, for sure, 23, 24, but I'm hoping that the manufacturers go up to 25%.
Okay, perfect. So I have here, I will try one last question, although we are short on time. The area occupied by the solar plants is huge, as you know. What kind of environmental impacts does solar do on the soil and on wildlife? And why aren't we doing this on the deserts or as floating farms?
Well, the first question is yes, there are some environmental impacts, and they must be, and it is a key point for approving installation in most parts of the world, is to have this environment study made. Secondly, yes, they are also being made in the desert, although the cleaning of the panels is a key issue, and for that reason, it is a little bit difficult to increase the implementation on the desert. Floating is a reality. I can tell you that there are at least for Portugal, there are being designed at the moment more than 100 megawatts for floating applications, with 1 plus in the case that the floating is being designed for water dams, and the use of these PV plants on a water dam reduces the amount of water that is evaporated and thus lost to the water systems or to the river. So yes, one should take care on the environment, and the other two options are already a reality.
Does the temperature on the deserts have any impact on the efficiency of the panels?
The desert temperature has a huge impact on the panel's efficiency and also on the inverter's efficiency. If you look later to my presentation, one of the things that are recommended on the power station is the shading of the power transformers, because direct radiation decreases their efficiency. Okay. And one can expect, only to have an idea, if we go above 50 degrees, one can expect in some manufacturers a decrease of the efficiency of 20%.
Okay, very good, very interesting to know. So I think that I have time, after all, for an additional question. We have already mentioned that the efficiency of the solar panels will continue to increase. Do you see the reduction on costs of the solar panels to continue to reduce, as it has been the last decades, on a semi-exponential form?
No. I would say that the biggest part of the cost reduction has already been achieved, at least with this technology. Okay. What we can expect is different types of technologies to emerge and probably get the same kind of efficiency from that point on. But with the current available technologies of solar PVs, frankly speaking, coming up to 25, it will be already a very good increase. We are in numbers of 21, so it is plus 20% of efficiency, and the costs have been stabilized. So every efficiency rise will be a cost reduction in practice. So we are expecting something around 20% at least of the cost reduction on PV plants, on PV panels, according to the power plant power rating.
Okay, thank you very much for your presentation, Alexandre. I think that we have run out of time. It was a very good presentation, and with this we close the energy transition session. And next we'll have Carlos Gomes da Silva, Galp CEO, to close the 2020 Galp Open Days. Thank you all, the speakers, and thank you all for your participation. I wish you a good day. Stay safe. Thank you.
Hello, good afternoon. Thank you for joining us in the plenary room of Galp Open Days. It is my pleasure to introduce to you Carlos Gomes da Silva, Galp Chief Executive Officer. Carlos, welcome. We are looking forward to listen to your plenary address. The floor is yours.
Having the chance is to address the closing remarks and the main takeaways from these Galp's Day sessions from ENP. It's an immense pleasure, specifically under the present market conditions and the challenge that the world is living today. So you may recall, most of you, that in the last couple of years, so this is the 7th session, we have been attending in person, and this year, with these extraordinary challenges that the world is facing, we have been able to keep it in a different manner, in a different framing, but with the same spirit. So it's absolutely amazing that our internal team that has been able to put together more than 1,100 people in several sessions, coming from almost 250 different companies all over the world. I would say more than 30 countries. This is unique. And this is how Galp's DNA is best represented. It's how we promote, how we in somehow leverage our position as a unique DNA of the ecosystem, of the stakeholders ecosystem that is unique and is absolutely crucial for the Galp's success. I think it is also important for all of us. There are 2 or 3 main messages that I would like to convey to you. The first one is very important and is related with the moments that we are living today. And this event is a very good example. So it has been a very organic one that has included not only the old folks that also used to come and to be with us, these folks in the last couple of years, but also the friends and the colleagues and the relatives that jointly have, in a cooperative and a constructive way, as bring ideas, challenges, and in a constructive way as promote these sessions. So I would like to underline this and to thank to you all that have participated on this. And especially a key and main message for the 85 speakers that have grant your time, your thinking, the way you have elaborate the presentations and organized the different sessions that have happened in the last couple of days. Our industry is experiencing what someone has called the perfect storm. So with the oil prices fight ongoing, we have been hit by this pandemic that has affected global economy. So we are forecasting the world, and we can go and look to the world institutions, the World Economic Institutions that are forecasting the GDP for this year, and the numbers is slightly a fall between 4.5 and 5% for 2020, and for 2021 a possible recovery. But this has a huge and dramatic impact in our industry. So we have observed that we have to reinvent and to adapt in a very fast way. So the last downturn that happened during 2015, 2016 has already showed that. The previous one in the early of this decade has also shown the same. But this one has been even more brutal, which means that the capex cost cuts, the alternatives that we have to introduce in our operations, the adjustments, the adaptation has been incredible. You may ask, and I ask that to myself several times, would we be capable to, from one day to the other, to reinvent ourselves, to start to work from home, to readapt our operations? And I'm sure if we will be in one of these sessions that we have had in the last couple of days, we might have different opinions on this, because ones would say maybe, the others it take time, but actually what happens is that has been, and that has happened very suddenly, and we have adapted. We have kept our business moving on, but at the same time, what we have see is a new normal happening that is significantly different from what has been our past. And this crosses with the second message that I have also to convey to you, that has been already in the spotlight and is related with the energy transition. So at Galp, we have been discussing this quite some time. And in the beginning, we were more, I would say, concerned rather than looking to the side of the opportunities. And I think that the only way to address these energy transition challenges, that is a global world purpose or common objective, is to facing it, is to embrace it. And clearly, I would like to state to you that this is clearly part of Galp's strategy, is embracing and being part with impact of this transition, with very specific strategic decisions. But for doing that, there are at least three elements that are absolutely fundamental. The first one is human factor. So it's people, is the willingness, is knowing that we clearly believe and we embrace this transition. The second one has to do with technology, with innovation, with digitalization, with the flexibility and agility. So looking to the world with different perspectives and different eyes. And the third element is related with the stakeholders, so the partnerships, the way we compensate, cooperate one to each other. And I think sessions and events like this one is clearly one that grants and contributes positively for that purpose. So a final word just to all of you that I think it is important, and it is my third message, has to do with what we can call the adaptability of this world. So going forward, we cannot use the same old ways of addressing challenges to new problems and to new challenges. We have to reinvent ourselves. We have to adapt. And for doing that, we have to accept that somehow we have to fail. We have to fail fast, to learn fast, and to be able to succeed also fast. For doing that, the only way to mitigate our risks is, from one side, keeping options and flexibility. They will be paramount for all of us. And in the other side, what we need is clearly to work in a network, in a global network, where the knowledge, the experience, the competences, the way of being and way of working from ones could be shared with others, and that could leverage our speed. And by doing that, there's a word that I would like to put in big relevance, which is trust. We need to gain trust one to each other. So I think the day that we are ending, it's the conclusion, and is the relevance and the example how Galp and Galp's, let me call like that, Galp's stakeholders community has been able to continuously to cooperate in an open, transparent, and trustable way. So thank you to you all for attending, for participating, for contributing, for organizing these Galp ENP sessions. And I hope to see you all next year, possibly in this way or in a, I would say, in a mixed way. Hopefully it could be in person to most of you, because that could be the conclusion that the world has recovered faster and has been getting to that new normal. And wishing to you all and your family and to your beloveds that you keep safe, that you keep healthy, and let's continue to work together and relate together. So thank you, and count with Galp's team, and on behalf of Galp's team, a huge thank you, and see you soon at Galp. Bye-bye.